short of it is...
Absolutely. How about at the end of the day? Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Hello and welcome to this very special Rask Live. If you can hear me loud and clear, please let me know in the chat. It'll be great to hear from you. And apologies that we're running a little bit late here today, as per usual. Fashionably late, not really, because you can see my sense of style. It's not really fashionable. Good afternoon, JJ. Welcome to this Rask Live. So if you are joining us live, fantastic. You'll be able to ask plenty of questions to today's special guest, who is Chris Bates. Chris is, as many of you may know, he was recently voted the #1 mortgage broker in Australia. So it's a really special treat for us to have him on the show. He's also a co-host of the Australian Property Podcast with myself, Pete, and Amy. But he also hosts the Elephant in the Room podcast. So we will be chatting to about all things property, banking, credit, these types of things, which are so important in this day and age. So thank you for joining us at a midday session. Normally we're recording it the evening, but sometimes we do have to record during the day just to get the guests and also to make it palatable to people in different parts of the world. So thank you, Hassan, Marco, everyone that said that they can hear me. Wonderful. I will just share my screen really quickly with you. For anyone that is watching on replay, thank you for tuning in a bit later after the fact. This is always available no matter where you watch. So if you're watching on Self Wealth, as I can see, Rob is. If you're watching on the Australian Shareholders Association or on Rask, it is available on YouTube channels to be playing back at any one time. Some of you may have heard this news that Rask Invest, our service, is now launching in the next few weeks. If you haven't already, check that out. There will be links available in coming weeks. You can also find that on rask.com.au. I'm super pumped about this new investing service that we're bringing to the market. So that'll be available in the next few weeks. Rask live every Wednesday for 60 minutes. You can get it on YouTube. Don't forget to hit subscribe. Wherever you get your YouTube feed, I guess is the correct phrase, you can hit subscribe and you'll get notified. Like, for example, today when I went live, I got a notification on my phone to say that Rask Australia, Self Wealth, and ASA is now live. So I probably didn't need all three, but I got them anyway. So you can subscribe. It makes your life a little bit easier. So this is my joke for the week. Let me know how I did out of 10. Did you hear the rumor about butter? Well, I'm not going to spread it. Now, I'm sure the man that I'm about to welcome to the show can probably have a say on whether or not that was a good joke. He's probably more versed in dad jokes than I am, put it that way. But we'll hear from Chris in just a moment. That's the joke for this week. I hope you enjoyed it. Today, we're talking about property. In a couple of weeks, we will be having Drew on the show to talk about retirement and going over some questions with him. Then we'll be discussing something else that I've been working on for a little while and answer your questions. It's all investing related. We'll likely have beta shares on the program in coming weeks, as well as a few others. Basically, everyone on this list has said yes. It's just a matter of teeing them up and fitting them into the upcoming calendar before Christmas. So here's a bit about Chris. Chris is the founder of Blusk. He started as a financial advisor back in 2007 and sold his advice business in 2020. Over the past 9 years, Chris has grown into one of Australia's top mortgage brokers and is passionate about taking the product providing industry to a trusted advice-based profession. He is known for regularly airing his views on sound property investing on both LinkedIn. He's got a huge following, probably the biggest following I've ever seen, and popular property industry podcasts, The Elephant in the Room and the Australian Property Podcast. So without further ado, I'm going to bring Chris into the chat. Chris, welcome to Rask Live, mate.
Owen, good to see you.
Can't see myself, but I'm on the wrong link. There you go. I was actually watching it on YouTube, so I was getting the guest experience. But good to see you always, and I'm looking forward to this.
Yeah, mate, absolutely. It's always good to chat. So today we're going to be talking about property, maybe even a little bit of property and shares and the debate that goes on there. I think it's a bit of a false choice when it comes to investing in property or shares. I think you can do both. But maybe just quickly, can you just tell us a little bit about Blusk? Like, people know that you're my mortgage broker. Before it was called Blusk, you're my mortgage broker, and I was very lucky to find you. But tell us a little bit about the business, mate.
Yeah, and I mean, just to hear on what you said about shares versus property, that's absolutely the case, right? It's not one versus the other. It's actually, they're just two different options, and commercial properties there, and all different types of share investings, there, and bonds, etc. That's lots of different asset classes. The only property or the only share crew, I think they're missing the point. They're just different vehicles and different benefits and pros and cons, I guess. So a bit about Blusk. I mean, it was a financial advisor. It was an advice business predominantly with mortgage broking, but we fell in love with helping younger people in particular, the 30, 40-year-olds. And their biggest challenge was property, right? So, everything from buying their first home to upgrading, renovating. Also, if they had a bit of equity or on top of their mortgage, they could get potentially more leverage into property than they could to other asset classes. And so we saw that as obviously their biggest opportunity as well with the tax settings like that. So we just doubled down on that property conversation and fell completely in love with it, and less in love with the insurance and the super and things like that. Most brokers sort of have come from a broking background. We came from a financial advice background. So we sort of really try to guide our clients in not just, getting the right mortgage and setting it up the right way structurally for future tax or for cash flow or buffers, but also they're using it the right way. Are they getting good assets that actually set them up? I think that's where the broking industry needs to transition into is more a case of actual, if I'm going to be a facilitator of this and help people get access to money, are they actually making wise decisions? And when you've seen thousands of people literally over, we've been focused 100% on younger people since 2012, pretty much. You can see what works and what doesn't work. And so we don't buy the property ourselves. That's a whole other skill set that you need, but we've gone and built networks with buyers agents all over the country. So not one group, they're all individual small businesses that are local market specialists in all different pockets around the country. And have usually been doing it 5-10 years and have got a little team themselves. That's what we do. We take a real strategic approach, help people think through their longer term plan with property, because property is such a lumpy asset, like it's high transaction costs. You're in it. You don't usually just flip it after a year or two like you can with shares. You sort of make that decision and then you figure out 5, 10, 15, 20 years later whether that was a good decision. And most people don't even compare it to what would have been a better decision anyway, the opportunity cost. But you don't really, it's kind of like you make this decision and then you get whatever rewards are in the future. And so we really try to slow people down to make sure they make just a fewer number of quality decisions.
Yeah, I like it. And it shows in the advice background that you have how people react differently when they've got a professional service. And it's not just you give a phone call and they're like, what's your income? Are you in a relationship? Do you have any debts? And then it's either hang up the phone then because they've made a judgment call of whether it's worth it or not for them. But you actually take people through the full process and educate them on the way through. Before we get into any more property conversation, I want to ask you the most important question of all, because you can jump onto Twitter or you can jump onto any social media platform or even the news, and you can see interest rates have done this, right? But then property prices have done this. So prices have gone up, Chris, over the last year. This is CoreLogic data as of November 1st. And this is the RBA interest rate setting. So you can see interest rates gone up, property also gone up, which for basically all the commentators in the AFR and all those forecasters that people tend to trust, everyone's basically got it wrong. So I'm curious as first of all, like, how does that happen?
Look, I've got it wrong too, right? Like, no one would have thought the rates going up 4%, right? A lot of the expectations on house price falls were if rates went up 1 or 2%, right? Not if they went up 4% or even maybe 4.5% if they go up a couple more times, right? And borrowing capacity is falling arguably 40%, but depending on how much income increases you've had, it might have fallen maybe 30 or 25%, depending on what wage increases you've had over that time. But So borrowing capacity has fallen, let's call it 30%. Interest rates going up 4%, but prices did go down. They definitely did fall quite heavily in the end of 2022, but then, they're almost recouping a lot of those gains, particularly in Sydney and, and Perth, at all-time highs and things like that. So other markets and regions are nowhere near that same sort of situation. But yeah, you wouldn't expect that. And there's lots of factors that go into that, yes, interest rates are one factor that drives demand. Yes, borrowing capacities drives demand. But then you've also got supply. You've got, the rental crisis. You've got the difficulty in the building sector. How hard it is to build at the moment. And you've just got pent-up demand. You've got this real desire for people to want security. Like even our tenancy laws, you can only get a 12-month lease. You can't get... So the home ownership dream's still there, but the home ownership rate doesn't match where the dream is. I saw a report come out this week from, I think it's McKinnon. What did it say here? I was just literally reading it before. 72% believe that they can own, but 88, 93% of millennials and Gen Z want to own, right? And that's not including the people who actually do own. So there's a real pent-up demand in the system, particularly when people get to the couple family stage. The desire for security and stability really increases, and they do what they can to get into the market. I think there's that in the market there.
I can see the Deepak has sent through a question. So anyone that has a question, please paste them in the chat now. We'll get to them in just a moment. So thank you, Deepak. There were a couple other questions I wanted to throw to you first. You mentioned that interest rates going up, and potentially some calls are saying maybe even higher right now. Can you maybe just give us you've got a team that does this around you, but
yeah,
can you maybe just give us a sense of where you're getting interest rates on mortgages now and where you think they could go in time?
Yes, this is an interesting one, right? So there's a proper bank war, right? Credit growth is a little bit slower. Banks' profits come from credit growth and margin on loans, right? And there's just broker market share has been going up dramatically, right? Like we did a Rask video a couple of years ago, Owen and I, on that video, I said 60% market share to brokers. It's 70% now, right? And it was 2%, right? So the broker market share just keeps continuing. As that continues, that creates more competition in the mortgage market, right? And so a good mortgage rate now, you can probably get around circa 5.7 to 5.8, depending on your LVR, depending on the size of your loan and things like that. But we've had things under 5.7, even recently. In saying that, though, 6 months ago, like May time, circa, rates were even better than that. The bank discounting was huge. It's actually come off a bit. That's hence why CBA actually had, negative loan book growth over the last quarter. Not sure everyone's really upset about that, but that's because they've come back on their pricing. They're nowhere near as competitive as some other banks like Macquarie and ANZ and things like that. But circa 5.7, which you take off the RBA rate 4.1, that's a margin of 1.6. We used to say a 2% rate above the RBA rate was a good rate. And so that shows just how much competition there is in the market and how much banks are fighting for it.
So 2%, previously you'd say, 2% above whatever the RBA rate is right now, which anyone can check on the RBA's website. So assuming that would be around about 6%, but at the moment you're saying and maybe one of the reasons is because there are so many mortgage brokers now in the country, they're frequently trying to get better rates for their clients. So it's keeping the banks honest and it's pushed that down, which is good news for borrowers. You told me a little while ago, I don't know when this was, so you have to correct me on this, but the key question for a lot of people is not just finding a better rate and being prepared to do the work and speaking to their mortgage broker, but a part of the equation for anyone, whether they're investing in property or just owner occupiers, is do I go fixed or variable or partially fixed and variable, like a bit of one and a bit of the other? Where do you see that now? Is it too late to fix? Is it too early? How are you seeing that?
Look, it's always a constant evolving. You should generally, put yourself in the variable camp. I think you'll win over the longer term if you play that, particularly if you constantly refinance. And, used to when I started broking, it was maybe refinance every 2 or 3 years and pick up an extra 10 or 20 basis points. Just in terms of the way that banks have been doing their pricing, particularly in the last 5 years, has been a huge loyalty tax. When I started in the industry, a good discount was about 1.2% off the standard variable rate. Now it's over 3%, right? So What that basically means is the bank have been increasing their standard variable rate and then increasing the discount for new customers and basically trying to take advantage of their existing customers who don't renegotiate. And so if you keep playing that game and you constantly are fighting for a better variable rate, I think you'd win over the fixed longer term. However, at certain times, the fixed is just such a good bet. Hence why in 2020, 2021, 80, 90% of loans were fixing. Very few loans are fixing now. I think, the expectation where you have to lock in the expectation of rate cuts over the next few years, you'd have to really be scared of your cash flow. I can't sustain any more rate increases. So this just really gets us through. But, even like 6 months ago, there was a good bet on a 1 year fixed rate. Which I actually took up, right? So, a good 1 year fixed rate at 5.75 I got was a good bet because where the variable rate was, and it's turned out okay because there's been a few more rate increases. So sometimes but only short-term fixed rate, I think at the moment, is a good bet versus the longer ones because we just don't know, if rate cuts do happen, how severe they will be, and you don't want to get caught on a high rate and not being able to refinance and a huge break fee.
So I said Cooper's just put a question in as well. We'll get to your questions in just a moment, guys. Okay, so only short-term fixed rate if people are going to do it, because it is like we talk a lot about on the show. We talk a lot about like the benefits of making good investments, dollar cost averaging, and these types of things. I remember chatting with an analyst friend of mine recently. He locked in a 5-year fixed rate in the end of 2020 or beginning of 2021. And it was something shockingly low. Like I think it was like 2.5% or maybe even less. I don't even know exactly.
Low,
yeah. And I remember he said to me, he goes, that's probably the best investment I've ever made, is just parking my money like against the mortgage and having the lowest possible rate fixed for 5 years. So that would be still, a couple of years to run on that decision for him. So he is not impacted in any way by the interest rate increases, which is just a wonderful decision. And so more people should be paying attention to where interest rates are going. Speaking of, do you think then, like obviously a lot of your clients are just kind of rolling with the variable rates at the moment. Do you think that there's a lot of scope for interest rates to keep going higher?
Well, I think, the expectation of the market's a 50-50 on what will happen next week, right? And then maybe there could be even another one after that. I think ultimately there's enough momentum in the market, right? And the extra 2 increases in interest rates, rates are already at 5.7%. So if they go to sort of 6 or 6.2%, right, is the buyer going to say, I'm not going to buy anymore? I mean, they might have 5% less borrowing capacity, but a lot of what's driving the market right now is lower LVR loans and also the higher income borrower. Because they're the ones who can only really get enough money to enter the market, right? And so there's this huge intergenerational wealth happening beyond what I've thought was possible, to be honest. We're getting clients that, hey, you can borrow $1 million, but you want to buy it too. You need $1 million, and all of a sudden they come back with it. And, I think it's the grandparents giving it to the kid. The kids are now having grandkids. They don't want them to move away. There's a rental crisis. They're asking their parents for help. The parents having issues with their super fund and tax. And, I just think there's a lot of money coming down. And, Jarden's research backs that up, and the higher income borrowers in the market. So I don't think they're going to change their plan. There's still going to be a rental crisis. Yeah, they've got to pay a little bit more for their mortgage. Maybe they'll just ask for a little bit more help. And I just think there is a lot of momentum in the market. I mean, I think price growth is starting to subdue. CoreLogic released their monthly data today, and you can see that, the rate of growth is slowing. But, the market's not, I think people under higher rates market, people are more picky, right? So they say, well, I will stretch for that property because I'm going to live there for 15, 20 years. But do I really want to stretch into that property on a busy road, south facing? It's noisy. It's got privacy problems. It's got a weird block. It's, maybe not in the nicest part of the suburb. It's not great near public transport. So the more compromised properties are still sitting on the market. You're still not getting, because clearance rates aren't 90%, there's still people that are being picky. But if a property does tick a lot of boxes, A, they're more likely to sell, and B, they're less likely to come onto the market right now because the people in them are saying, why would I sell right now? Because A, I don't want to upgrade. It's going to be I've got to pay 6% interest rates on the next. And that jump is quite big right now because the bigger, better, when you want to upgrade, you want to get into a bigger, better property. They're usually the ones that have actually gone up the most over the last few years, particularly, with the work from home movement and things like that. That desire for space is even greater. So the jump's bigger, and it's also a bigger jump to make under higher interest rates. And people can't get the money. They haven't got the borrowing capacity. And plus they don't want to do that because interest rates are high. So there's a real tightening, in particular, it's all time since 2010, it's all-time low in the housing market. Unit market's completely different story. That's driven a lot by the investor market, and the investors absolutely are selling if they're feeling any financial stress because they're not living in the property. And so unit supply is really high, but housing supply is really low, and particularly in the better parts of suburbs and the better properties because they're basically stuck. They'd love to upgrade, but they can't and they don't want to because rates are high.
Yeah, fair enough. I see Rob's just put some stuff in the chat for the self-wealth community. There's a link there to find out more about Chris and what he does. A lot of people know this already, but as I said, Chris is my mortgage broker, and we've formed a partnership with Blask a few months ago now, maybe at the beginning of this year. And so just so for full disclosure, Chris and I have been working together for quite a while on helping people get into property. There's also a free course on the Rask website, which Chris and Amy Lenardi created. So one of the first questions that came through from Deepak was that how can I approach engaging with property professionals if I'm not financially fluent and don't understand how property works, and I'm getting FOMO seeing all the housing boom in Australia? Like, who can they approach? How can they go about it? What's the first step, mate?
It's actually a really dangerous. It's a good question because it actually highlights the dangers on the property market and who you speak to, right? The property market's completely unregulated. It's unregulated for a reason. There's so much money the government makes in new housing, stamp duty, developments, and it's our biggest asset class. They don't really want to regulate. They want to basically just see price growth, right? So you'll be really careful because there is a lot of spruikers in the property market, particularly selling new property. I would say that's really one of the key dangers. But I think there's also this explosion in investor buyers agents, right? Data driven. We can pick, these amazing investment locations that are high yielding and great growth. Like a lot of those things don't make sense when you start cutting down the fundamentals behind them. So they might not be buying new, but that doesn't mean that they're buying great established properties as well. They're potentially just doing it on some things that look great on the data, but not backed up by fundamentals, I believe. So you've got to be really careful who you talk to. Ultimately, it's around thinking through your life. Everyone's got different lives, and I'd rather wait 6 months and get educated than enter. We literally just did I got a call feedback, a client who really rushed to purchase and, regretted it. They didn't actually speak to us. They came to it after they purchased, and they've now realized, 12 months on that they did buy a dud. And so you don't want to be in that situation because properties, it's really hard to unwind. Like if you buy some shares and it's not working out, you just take the hit, you get out. A lot of people don't, to be honest. There's loss aversion, but you can get out pretty quickly, and it's liquid. In property, particularly if you buy a dud, it's hard to sell. Like it's easy to buy, it's hard to sell. You've got to, if it's an investment, probably got to get your tenant out. They might not be taking care of the property. You might have to take it a while to sell, so you have to have the holding costs, and then it you might not sell it all. You might have to get it back on the rental market. You might have to do repairs to it to sell it. So it's really, when you get it wrong, it goes really bad, and particularly that if you leave that decision many years. And so I think the first thing is getting educated. I'm going to plug for the Australian Property Podcast there, Elephant in the Room and things like that. Get educated but think through your life, really. I think we're all on different lives. Forget about the society. You're not successful unless you're a property owner. You just have to read one report, the Core Logic Pain and Gain report, to realize that a lot of people in property do lose, And so are they successful if you lose money? Or no, because they've got an investment property. So anyone who says they've got an investment property or multiple investment properties, don't get too excited by it, and usually the people who've got the most properties have actually got the most problems, if I'm honest. And so just look about your life. What do you like to achieve? Where are you going to live long term? Have you got a partner? What's their plans? Like, are you going to have kids? Can you get a good home? Because renting is a challenge. If you can't afford to get a home, or your life plan's really, hazy where you're going to end up, then I think it's just using your money, but getting into one really quality investment property. And sometimes you might need to wait because you need more savings, or you need to wait for that pay rise, or you don't know exactly where that is. And then engaging the right person in that market. So,
yeah, it's so hard. I just want to reiterate what you said. And that's the reason that I wanted to work with you, Chris, and Amy and Pete when we started the Australian Property Podcast. But the reason I wanted to do that is because it's because it's so unregulated. It seems like you can't trust anyone. No offense. Like, it seems like it's at first you seem like, who do I actually trust? And it's not until you kind of build that foundational knowledge of what is right and wrong and where people tend to go wrong really quickly, that you start to get a sense of it. So Deepak, it's really not a plug because it's a free course, but you can go and take that free course, or you can listen to any of the podcasts. There's some great podcasts around, not just the ones that we work on. I see Mark did say that he locked in his rate at 2.24% in 2021 for 5 years. That's just unreal, Mark. So well done to you. Cooper did posed a question earlier on. Just wondering what the process is for someone refinancing who has a first home buyer scheme mortgage if I haven't paid down to the 20% equity to release me from the first buyer portion. I think this can depend on the location as well, depending on where you bought it. Will I have to pay LMI if I refinance and all these types of things? I guess the question can be generalized because Cooper knows we can only provide general thoughts here. Just around those schemes, Chris, and then redrawing equity. I think I sent you a text message the other day saying, hey, mate, what's the current feel on refinancing now? Where is that line in the sand for banks?
Yeah. Look, I mean, generally speaking, you need to get under 80% LVR to refinance. It'd be interesting just to go back to that bank and just see if you can get a better price. I mean, you don't have to refinance to get a better deal. And
True.
so, and the banks have been really good there, to be honest. They've realized that if they don't look after customers, they'll leave when they can. So they could make some money off you for another 1 or 2 years, but then you get a bit of a, sour taste in your mouth, right?
Yeah,
well, they didn't look after me, and now I'm going to refinance elsewhere. So I just go back to them, ask for a better deal. Look, depending on what you do for jobs, certain professions, you can refinance at 90%. There might be some other options, but generally speaking, you need to be under 80%.
Yeah. So I just wanted to highlight something you told me ages ago. That some banks, just to give you a sense of why it's important to speak with a financial advisor, like if you run your own, a mortgage broker, sorry, if you run your own business, there's even options for certain banks. If you have a business and you want to do a line of credit for the business, some banks are more receptive to a line of credit for investing and these types of things, right? Like, it's not just like a one size fits all for every single bank.
Oh, absolutely. I mean, particularly for self-employed. But every bank has different rates, but they also have different policies. So they have different servicing calculators. They have different niches. They'll look at, casual versus bonuses versus self-employed versus contractor. They'll look at them all differently, right? And so you'll be able to borrow different amounts from different banks. They'll have different product niches. Some will do like, guarantor loans, and some will do bridging loans. And so there's all these, and particularly when you've got more complex needs, you do need to be bank shopping, not just for rate, but also for the right structure. I mean, what you're talking about there is something that NAB will do for certain businesses where you'll end up to 80%, but also will end up to 100% for some business owners as a different type of line of credit for them and things like that. So, but a lot of other banks don't do that. So it's just, that's the role of a broker, though. We look at your situation and go, how are we going to best structure this for you, but also get you the best deal?
It's just sometimes you don't know what you don't know, right? With finance, like I was learning the other day, even some options around director loans and these. If you run your own company, like there's so many options. If you have a good team in your corner, mortgage broker, buyer's agent, if that's what you want, accountant, financial advisor, having a good team is so unbelievably valuable. And it's every time, like every 2 months, I have this realization every time I discover something new. Hassan did ask a good question, which is, what is the impact of rates rising on the construction industry? Any thoughts on the impacts, considering higher rents will keep pushing inflation higher and higher? How do you think about that?
So Pete and I have discussed it a lot on the Australian Property Podcast on our weekly 2 cents on a Sunday morning. Look, I really feel for the construction sector. You had rain, COVID, labor shortages, materials through the roof. The home builder created unnecessary demand, and profitless boom. You've now got massive, construction failures now on the back of all this, and projects aren't stacking up. When you look at the cost to build, and so I think a lot of construction industry runs on a pretty small margin. I think the return on equity is pretty good, versus what they invest and what they get back, but their margin's really tight. So if it goes wrong, it goes wrong. Hence why you're getting a lot of businesses going under. Look, I think higher rates will only do 2 things. It will reduce how much people can buy, can borrow, and it'll reduce how much they want to spend, right? And right now, the numbers don't stack up anyway. For a lot of developers, you look at them, they can't basically build things for first-time buyers because first-time buyers can't borrow enough money to justify doing the build. So developers who are doing the high-end stuff that particularly suits downsizers, so the more affluent parts of the capital cities, they're still making projects stack up and they can sell them. But a lot of projects just can't get out of the ground right now just because the cost to build, then you add in the margin, and they've got to charge a bigger margin right now because they haven't got much in their kitty, right? So they need to recoup that and build up their sort of emergency fund. And I just don't think they're willing to make that risk. And a lot of developers, if you look at in the media, they're just getting out of resi because of that, because they've been burnt. And so I just think it's tough times ahead, let alone with the material issue. You think about materials, it's not just the resi sector that uses them, schools, freeways, the Olympics, like big transport infrastructure. Like there's so many other things that are going on that are taking labor and materials that are affecting, and then you've got a rental crisis. So yeah, I don't think it's good news, to be honest, particularly in the resi sector, unless you're working on the high-end projects. You look at a company like Fortis in eastern suburbs of Sydney, they're pretty much doing development on every corner in Double Bay. But that's Double Bay, right? That's not in lots of other parts of Sydney where these projects don't stack up.
Yeah, it's such a good point. I think I remember looking at this through Self-Wealth a little while ago. And Rob, by the way, I did put a link. If you haven't joined Self-Wealth, you can using the link he's put in the chat for 10 free trades. But I showed on that, you made such a good point there where you talk about the return on equity. If you look at the return on equity of these building companies like Lendlease or Metricon or whoever, their return on equity can look quite good because that just compares their profit to their shareholder equity. But oftentimes they don't have that much equity because they're using so much in loans and liabilities to fund the projects. So their return on equity looks great, but their profit margins are tiny. So then as soon as something goes wrong, they just belly up almost instantly. Chris asked a question on commercial property. Lots of my friends are buying offices and warehouses, and they tell me it's easier to get finance and easier to manage. Thoughts on this, Chris? Generally, just as like maybe not as a strategy, or even if as a strategy, but just lending against commercial property. Like, how does that world compare?
It can be a little bit like, so you can potentially get higher yields, right, which can help with lending, and but there can be issues with LVR. Like banks won't want to lend at certain. It depends what you're buying in commercial. Like commercial is one of those things where the banks do look at it very differently, like the LVR they'll lend up to. And particularly a lot of the stuff I think that people are buying in the commercial space is the lower end stuff. Like it's not the greatest, it's not the shopping center, right? Like,
yeah.
And you talk to some really, well-known commercial people, right? Like look at where they think the sweet spot is in commercial sector. It's usually past the everyday mum and dad investors borrowing capacity and where they can enter the commercial.
Right.
And yeah, I mean, it has done quite well recently, right? Under lower interest rates and a lot of money going there. And that's seen great price growth. But is that going to stack up under higher interest rates when someone in their, retirement years who should be buying commercial property? Do you buy commercial property that's yielding, 6%, or do you put it in cash that's giving you 5%, right? Like, yeah. I think those days where the cash was 2% and you get 5 or 6% on your yield on your commercial property, a lot of money went there, which craved capital values. So my view on commercial property is, the stuff you really want to own is probably out of your budget. Like, and, you look at the best commercial investors, they do go up the tree. They really try to get those lower risk, high growth assets, those real cornerstone, scarce assets. I just don't think that's what most people are buying in the commercial sector. So that would be my view. You might be able to get a bit more lending, but you might have LVR issue. And I don't know whether you're really getting the top quality commercial properties.
I think I couldn't agree more. I think a lot of our finance industry and the investment industry hasn't really adjusted truly to higher rates yet. Like, I don't think that it's fully sunk in. And that's why I feel like rates don't go to infinity and beyond, because I think the effects of it are only just starting to impact the economy. And if you think, like you summed it up so well there, like if you have a risky asset yielding 6% or a risk-free asset yielding 5%, like what you're debating over is 1%. And it's not necessarily just the individual buy, it's the market that moves, right? I'm going to get to Lemon's question in a minute because I wanted to put something to you, Chris. But Mayraz just wrote in and said, thoughts on cross-collateralized loans or might be better off getting a standard loan, a type of loan for more than one investment property?
Oh, so there's a lot of misunderstanding, I would say, with cross collateralization. So a lot of people think that if you have all your loans at one bank, it's cross secured. That's not true. You can basically have your loans all separate loan agreements to separate properties. And so each loan is under 80% of the property value. So rather than like a big loan of $2 million secured by 4 properties and one loan, or even if it's different loan splits, it's still secured by the properties, right? I think that's and it is a mistake we do see. We do see clients come to us in that structure, which it didn't need to be. So how you secure your properties and how you structure them is part of the decision making. But it doesn't mean you need to go to different banks, because there's sometimes advantages of keeping it one package fee, which is a very small benefit. The ease of access, you've got potential rate benefits. You can maybe play in the private banking space because there's minimums there that you need to access and things like that. So yeah, it's just how you structure your loan. So if you had a choice of cross-secured or unsecured, or individual properties, then you'd absolutely go. That's not unsecured, but individual properties per loan, you'd absolutely go for that, because where the issue comes is, I don't know, this is a dire situation, but you basically can't pay your mortgage back and you default on one of your properties. The loan that you default on is the property that they'll sell when it's not cross-secured. But if you have them all cross-secured and you default on one of your loans, they'll just go and sell your best asset, which will probably be your home, right? They won't go, oh, I'm going to sell that apartment that is going to take me 6 months to sell. They'll go and say, what can I get my money back quick here? And they'll just start selling your best assets first to recoup their money at usually fire sale prices. So it can wipe you out. But I mean, it's not a great situation, a bank foreclosing on one of your properties anyway. And if you got to that situation, really struggling, you could just sell off one of those properties, right? So that's where the issues, I feel, lie.
It makes sense. Okay, so I wanted to put something to you. So when I've started in this industry as a typical investment analyst and whatever, I thought, debt is bad and all these types of things, like most people. And I thought, well, I don't want to leverage up my personal balance sheet to buy property. It seems so ridiculously expensive. And then, of course, it went up like 3 or 4 times. But I have this kind of belief now that if people are pursuing financial independence, whatever that may be, like whatever flavor that is, whether that's retirement on time, whether it's a comfortable retirement, whether it's an early retirement, I think a lot of people, at least in the Rask community, are seeking that. Like they want passive income, they want to grow, but they also recognize, and I also recognize, the power and unique feature of property, Chris, is that you can use leverage to get exposure to this asset class. And I think, like, for people earlier in their journey, particularly, 20s, 30s, 40s, if they're planning to be employed in a secure job, they've got their strategy done, property seems to be like a really well-worn path and a really sensible path, it would seem, provided you buy the right property. That's probably the key asterisk, number one. And number two, provided that you don't let the debt overwhelm you in the worst case scenario. But what I see in our community, Chris, is like a lot of people using properties, not a lot, like they don't go and buy 5 properties over the course of 10 or 20 years. They might buy 2 or 3 really high quality properties. But then as they want to approach retirement, like say 5 years out, they start to deleverage those properties and start to move that money into ETFs, into listed investment companies, into REITs, and these types of things that pay passive income. So they expand the asset base, the exposure base early while they can afford to take that risk from their salary perspective. And then as they prepare for retirement, they start to consolidate into more liquid assets that pay net positive income. So like positive cash flow, right? Rather than negative geared assets. As I described that to you as a very general gist, and everyone should seek the advice of a planner and a mortgage broker and all that sort of stuff. As I described that to you just now, does that seem like a strategy that makes sense to you?
Absolutely. So, generally speaking, clients come to us in their early to mid 50s. Everyone's got different work plans, right? But it's a really tricky situation because usually they're in they probably put off their retirement planning a little bit too late, to be honest. That was one of my frustrations when I was an advisor. They came to me and they're like, I want to retire in 5 years and I've done nothing besides buy a house and, I've got $1 million shortfall. What can I do? It's like, well, it's hard. Like I haven't got a magic wand. So that situation there, it's hard to recommend resi. Like it's sort of like, because you're not really getting the benefits of leverage, because usually they can leverage almost just as much into shares, and shares are a lot more liquid, a lot more easy to sell down in retirement. The time frames there, the negative cash flow might not be as big. So you're not getting a big lumpy asset. And so, we think they really need a really strong retirement planning if you're in that age. You really need to think through what you can do with super, what you can do with other investing, and be very hesitant entering resi in those age brackets, particularly if you're getting closer to 60 and you're looking to stop work, right? Most brokers probably wouldn't say that, right? Most brokers come from okay, you want it, I can deliver it. If you want to leverage yourself into super fund, we can do that. We're very against that as well, right? We think that, punting your super on a property is really dangerous unless you can get a good asset. And most people can't. They haven't got the budget to do it. So that would be my advice. Younger, absolutely. Like, it's hard to argue if that person is in their 20s, 30s, and they've got, they can get, a 90% loan, put a 10% deposit plus stamp duty, so 15% down. And let's say on $1 million property, that's 150,000, right? Then they live in it. And so they save on rent. Maybe the rent's not too far off the interest, right? And that 150,000 has got them $1 million property, and they live in it. So it grows tax free. It goes from $1 million to 1.4 million, right? Like a 1.3 million, right? Their 150 has now turned to 400 or 500. Tax free, right?
Huge.
And that might have happened. That's a 30 or 40% growth. That might have happened over 6 years. Well, it'd be hard to triple your money in the stock market, right? After tax, right? It's very hard to argue with the leverage return. However, not all properties grow at the same rate. If that was an apartment in Sydney, if you bought that apartment in Parramatta, Epping, St. Leonard's, even places like Rosebery, has that gone up over the last 5 years? No, it didn't even go up when rates were 2%. It's actually gone backwards. So, but if you bought a little apartment in Neutral Bay, or you bought one in Rose Bay, or the beaches, it's a completely different world. And then the housing market works similar, etc. So it's not just getting into property. It's getting into a good asset, and being really strategic around that, because and then it's so hard to argue with those returns. And the same for investing, like if you got a little bit of equity in your home, but you've got a great borrowing capacity, right? So you can probably service a negative cash flow on a property. All you're really putting down there is that negative cash flow, because you're using the equity in your home to fund the deposit on the investment property. So that negative cash flow, which might be 5, 10, 20 grand a year, is allowing you to borrow, let's call it $1 million or $1.5 million property or something, right? So that 15, 20 grand a year is getting you the growth on that property. And, if that property, that leverage return, so 15, 20 grand a year, is if that's nowhere near as much as what that property is growing, let's say it's growing at 4 or 5%, well, that's 4 or 5 times on your money, right? And that compounds over time. That gap, that servicing amount reduces per time. So that's where resi really works, when you've got enough borrowing capacity, enough leverage to get into good assets, and you can afford to hold them, and you've really thought through your cash flow, your buffers, because you can easily over leverage, right? Well, you haven't got enough buffer, and something happens, and then you have to sell assets, and then you basically stamp duty, selling costs, market timing, market risks, all these things really explode. Same in shares, right? Like you've got to go in there with a long-term view.
I've got 2 more questions on the back of this. One is, so say like you can't, so obviously the first step for a lot of people is the hardest if they haven't invested in property before, they haven't bought a property. What's your view on people when they buy in a different area to where they live? I don't know. I can't remember what it's called. Not maybe like red vesting, I guess. Like a lot of people come up with these wonderful ideas, and I just hear alarm bells. They're like, I'll buy in this other state, and I've heard from a mate that this is that and this is good. And you think that's just a lot of, have you sat down and carefully thought about that? But like, if you do that prudently, like you research the area, you've got a good wage, and you're thoughtful about speaking to the right people. What is your view generally on like buying a lesser, like less expensive property and owning that while renting somewhere else?
Yeah. So when I started in broking 2013, 14, like I was like blown away when I started working with borrowing capacity calculators at the banks. I was like, surely they wouldn't lend you that. Like, And surely I can't do that. There's all these holes in the borrowing capacities, and different banks would lend you dramatically different amounts and there was all these like if you fix your loan, you'd be able to borrow more. Like there's all these holes in it. And APRA came in 2014, 15, 16, 17, started tidying up all these bank borrowing capacities because you could borrow 10, 12 times your income back then. And in particular, you could borrow a lot more for investment than you could for your home. And so as a investor, you would say, well, it doesn't make sense to me putting money into home because my leverage, my market exposure is way less. Particularly rates were higher then. Interest only was easy to get. You get 15-year interest only. And so it made sense in that world to actually leverage up into investment properties and rent where you want to live. Rents were much cheaper. Rents, vacancy rates were much higher, much easier. And with rates being higher, homes were more expensive, right? So that was a perfect time to be rent vesting. But, things sort of changed. Now you can borrow pretty much the same whether you're buying a home or an investment property. Your rents have gone up. Vacancy rates are really low. Your borrowing capacities are much tighter. I mean, it's probably 4.5 times your income now versus 10, 12 times. And
Wow.
you can see and rent vesting comes a problem as soon as you get to the family stage. I'm happy to rent when I'm a single. I'm happy to rent as a couple. If we get kicked out, it doesn't matter. I have to move and ask some mates to help me, but it's no big deal. As soon as kids come along, that it just naturally, you want stability, security. You don't want to be moving the kids around every year. You've got primary schools and school zones to worry about, and getting into childcare is a nightmare. And so the home security goes up dramatically. And so I'd say that's where rent vesting comes unstuck. People have bought all these investments and haven't thought through their home ownership journey. Then they decide they want a home. Then they've got to sell all these investments. They may or may have not done very well once they've got to pay stamp duty, selling costs, capital gains tax. And then usually where they want to live, and say it's a capital city, that market's moved, right? So they have, 2015, 18, they started this rent vesting strategy. Well, house prices in Sydney have gone up as well. So whatever they made on the right hand, they end up having to pay on their left hand anyway. That's potentially better to invest if you're buying well than leaving the money in the bank. But when you're comparing whether just buying your future home or something that you can live in versus this rent vesting strategy, it often doesn't stack up. In saying that, though, we also there's something called the 6-year rule. So let's say we often, talk to clients about this. So they, young couple, haven't got kids yet, don't want to move out of the city, but they want to longer term. Maybe they've grown up in the Central Coast or Wollongong or or in the outskirts of Sydney. They're happy to move there when they have kids, but they don't want to move there now. They buy there, they live there for a year, they move back to the city, and then they have that asset growing for them tax-free, something called the 6-year rule. So that's a good way of doing rent vesting, because what you do is you lock in your future home. You get the tax advantages of rent in terms of negative gearing, but you also get the tax advantage of your house growing tax-free, and then you get the lifestyle benefit of still being able to live around the city with your mates, and while you haven't got that need to live in that location.
So there's a 6-year rule. People can speak to you or look that up.
Yeah.
My other question, just in the interest of time, is, and I know Andrew. Andrew Page is the founder of Strawman, and he's I don't know, inadvertently, but we've had him on the previous version of Self Wealth Live not too long ago. He's a phenomenal investor. I think he's one of the best investors in Australia. Wonderful small cap analyst, and we had him on the show, and he's inadvertently become a poster child for the rental crisis in Sydney, because he's got a couple of kids. He's moved something like 10 times in 15 years or something like this. And he owned a property. That was the crazy thing, is he owned a property and he saw the returns that he was getting from the stock market. And he thought to himself, well, I'll just take my money and I'll just put it in the share market. Now, I remember thinking when I first heard about this, and Andrew, I don't think I'm speaking out of turn. I remember Andrew and I talking about this briefly, and I said, do you regret selling? Because couldn't you have just taken the equity and redraw that equity as a line of credit to then invest in shares, like to use the debt to buy the shares? And I think that was his regret, that he didn't do that, because then he would have maintained the family home, but then taken out a separate line of credit to buy the shares, which potentially, if they structure it right with your accountant, is tax deductible, that interest. So can you talk about that that strategy as well, and how people use that strategy?
Yeah. So I mean, that's the thing. Resi is such a great asset for banks, right? They're all invested in this, right? They're invested in pumping up the prices, and so you can lend on residential property really easily, 80%, 90%, even more than that, which we spoke about before, right? And so, I think the misunderstanding there is that if you want $150,000 or $200,000 in the stock market, well, what potentially you're better off to do is get your properties first, build that equity in those properties, and then you can redraw that equity to then get your exposure to the stock market. And that equity that you redraw, yes, you pay interest on that, but that interest is tax deductible. So that cost of interest is already at residential rates, which might be 6% now, but after tax, 40, 50% tax rate, what you're on, it's really only costing you 3%, right? Or 4%. And then as long as your return on that is greater than 4% a year, then you're making money. Plus, you get the home ownership growing tax-free. So what you basically do is you use your money, get a property, you buy a good asset that goes up in value, and once that property's got equity in it, then you basically redraw what your deposit was to buy that property, and then you get your exposure to the stock market. So you do get a little bit of a delay there. But if that property continues to go up, then you can get actually more exposure to the stock market because you can keep redrawing the equity in the property. Whereas if you bought some shares, you're only going to get more exposure if you keep saving. And so you haven't got and you can do margin loans with shares, absolutely. And you've got the equity builder at NAB and all that sort of stuff. So it's not to say you can't leverage shares, but you've got issues with margin calls.
They're much more expensive. They're very risky. Yeah.
Yeah. And the cost is higher. And so, whereas Resi, you can get a 30-year equity release and even interest only for the next 5 years, and it can be at a good rate. So that the bank's not going to call on that money for me, right? I'm not going to get this. If stock markets fall 40%, I'm not going to have to rush and sell or dip more money in. And so it's a much safer way if you know how to do it. So if
they wanted to do that, Chris, they would obviously speak to a mortgage broker like yourself, but then also accountant. Do they need? Would you say get tax advice or?
Look, we definitely will give you an explanation on how debt recycling works and how does it work with loans and structuring. Absolutely, you should then run that through an accountant. It defies. One of the reasons we sold the advice business. One, we stopped doing a lot of that advice. We didn't want to do the insurance, the super stuff. We just wanted to help people on their property decisions. We're referring it out anyway. But two, because a lot of financial advisors were referring to us, right? And we've really grown that part of the business. It does defy belief, though. A lot of advisors don't get this weight because they don't understand loans and structuring and what options are within the bank. And so we see clients with home debt, significant home debt, and significant share portfolios that have no debt attached to them. And that's just a really big no-no. There's a huge advantage of paying off the home and then redrawing to buy that share portfolio. It's just something called
huge
debt
tax
recycling.
Yeah.
And we see it all the time. So if you're in that position with home debt, particularly under 6%, after tax, and you've got this big share portfolio, you have to be very concerned around capital gains tax but often they're not as big as people because they've got a few duds in there as well. They can potentially just recycle and get back into their market exposure. Maybe they dollar cost average back in and things like that. So,
such a good point.
Yeah.
There is a link just below the video to learn more about Chris and the team at Blusk, or you can listen to the Australian Property Podcast. So if you do want to work with Chris and the team, you can obviously see these are wealth of knowledge. I actually lucked out with Chris and Ben from Blusk because I knew them before Chris was voted number one as my claim to fame. So just really lucked out with working with you guys. And I can see there were some questions that have come through, like from Colin. And I would just say that go and speak to the guys, like just go and chat to them, give them a call. Whoever your mortgage broker is, your accountant, etc. There are certainly options for everyone basically across the spectrum. So reach out to them, give them a call, just have a chat with a trusted mortgage broker. But mate, we've probably run out of time for today. I just want to say thank you. For anyone that's new in their journey, you can get Chris's free course on Rask or get in contact with the Blusk team once again. So mate, thanks for sharing some of your wisdom and some of your lunch break with us. Really appreciate it, mate.
No problems, mate. Good to chat. And thanks, everyone, for tuning in. We'll talk soon.
Thanks, mate. All right. So that was Chris Bates from Blusk, founder there. Frank says he is the GOAT, but he is good. I hear a lot of rumbling from others, but he's good. Well, that's wonderful. Yeah. I do really enjoy getting the chance to chat with Chris. When I asked the Rask team, of all the podcast hosts, who do they like to listen to the most? Almost all of them say Chris. None of them say me, by the way, which which is always funny. So yeah, I just want to quickly finish this live off, of course, with a few slides. We'll be back in the next couple of weeks. So don't forget, you can chuck your comments in the chat. Even if you're listening after the fact, if you're watching this tonight and say Perth time, you can leave a message. You can see the comments in the videos. I check all of the videos for comments, and so does Rob from Self-Wealth. So just let us know. We will be hosting a webinar for the new Rask Invest service coming up in a couple of weeks. So if you are on the Rask emailing list, please check out the email that will come probably in about a week or two. Our members already know what's happening, but everyone else doesn't. We're keeping it under wraps for the next few weeks until the webinar in a couple of weeks. So check out your newsletter if you haven't already subscribed. Do that now. So this is my quote for today: buy when everyone else is selling and hold until everyone else is buying. This is a quote that comes from mastersinvest.com, but from J. Paul Getty, which talks about the wisdom of the crowds and why the crowds are often wrong. Oftentimes, the best time to buy is when everyone else is selling, and you make money from holding. And the way you make money from holding onto a long-term investment is because everyone else wants to buy it, or in the case of shares, because the company gets more profitable over time. And a lot of people think you need to do something in order to make money, and in fact, you don't. You don't actually need to do anything. There's that old cliche of don't just do something, stand there. And it's a really I guess important lesson I keep coming back to is like sometimes you just let the market do the heavy lifting for you over the long term, and that's why we're all investors. So Lemons, you did ask a question. What resources or courses would you recommend to learn more on these topics? So if you're talking about property, Lemons, you can honestly, I'm saying this because it's free. The Rask property course is free, so you can go and check that out. A lot of people have taken. We've actually enrolled 1,200 people this year. It's just a free course. You can go and take this. It's just on the Rask website. If you want to learn about property in a more less kind of focused way, you've got our Australian property podcast. Shameless promotion there. You've also got podcasts like the Property Couch, which is really popular in Australia. So I think the Property Couch is currently the largest. This one's probably the second largest. There are others like Chris's Elephant in the Room podcast. There are a couple of others, but those are the big ones now. So go and check out those. It's so important to learn about property. I'm glad we could finally do a session. Frank, you've said, I listened to his discussion with Thornhill, and his grace in discussion is amazing. We'll contact him. Well, thanks, Frank. Yeah, Chris is a gem, a national treasure. So, and Thornhill is too. I'd love to have Thornhill on the show. We've actually got him on our list of people to contact in 2024. So cool. All right, guys. Well, we'll be back next week. We've got Drew coming up in a couple of weeks. Hopefully, we'll get Sam Huppert from Promedicus on the show either late this year or early next year. Don't forget, you can join Self-Wealth using the link in the show notes. You can use the link in particular on the Self-Wealth YouTube channel, and you get 10 free trades when you sign up. You can contact me on the Rask website, rask.com.au, and feel free to have a chat. And don't forget, as Shad's just said, a great interview with Kate Campbell on her new book, Buying Happiness. Check that out. All right, guys. Bye for now. Thanks for tuning into this lunchtime session, and we will speak to you probably in about 7 or so days is what I'm going to say. Probably about 7 days. In the meantime, happy Halloween. I'll see you then.